Imagine if your rent, your groceries, and even your morning coffee were calculated on a scroll with inked numbers and the occasional squirrel-sketched margin note, then auctioned off to the highest bidder over tea and baklava. Welcome to Ottoman Tax Day. In this video, we're cracking open the Sultan's ledger, no dust bunnies, just meticulous columns of land measurements, harvest yields, and head counts, and uncovering a system so mathematically savvy it would make your Excel sheets weep. From village surveys that mapped fields down to the last olive tree, to tax farming auctions that turned state revenue into high-stakes poker, we'll reveal how an empire spanning 3 continents balanced its budget and kept its cavalry mounted, all without a single calculator. Stick around. By the end, you'll know why today's tax offices could learn a trick or two from a 500-year-old double-entry ledger. The Ottoman tax system rested on a foundation of precise measurement, systematic record-keeping, and innovative delegation. First, Tahrir surveys mapped property and population, creating a reliable base for taxation. These surveys fed into defter registers, which listed households, land holdings, and tax liabilities in extraordinary detail. Tax revenue was then assigned via iltizam tax farming contracts auctioned to private collectors, linking state needs with market incentives. Concurrently, the Timar system allocated land-based revenue rights to cavalry officers in exchange for military service, creating precise yield estimates and aligning fiscal and military structures. Finally, the Murtaban accounting method inherited from Abbasid practice provided a stair-stepped ledger system for daily entries, ensuring accuracy and accountability. Together, these interlocking institutions exemplify a pre-modern fiscal regime that balanced mathematical rigor with pragmatic governance. Lessons still relevant for modern public finance. Cadastral surveys, Tahrir. Mapping the empire from the mid-15th century onward as the empire expanded into the Balkans, Anatolia, and the Levant, Ottoman administrators conducted Tahrir surveys to catalog land, population, and resources in newly conquered territories. Each survey began with local informants, village elders, and religious leaders, who provided information about households, cultivated acreage, and land quality. This data formed the basis for equitable taxation and informed military provisioning. Survey teams measured land using standardized units, the dunam for area and the sift for labor capacity. They recorded yields in kayet defteri, registration books, noting variations, e.g., wheat yields per dunam could range from 200 to 400 oka depending on soil fertility. Officials then applied proportional tax rates, often 1/10 of agricultural output USHR for Muslim farmers, 1/5 in some regions, to calculate dues owed to the treasury and local Timar holders. Tax registers, defter, the fiscal ledger, the defter tax register, was a double-entry ledger listing every tax-paying unit, individuals, households, and villages, alongside their assessed liabilities. Entries included the taxpayer's name, religion, land classification, mulk, miri, vakuf, number of adult males, and detailed obligations, land tax, riasemi chift, poll tax, sizi for non-Muslims, and extraordinary levies, avaris, during wartime. Defter records served as legal proof of tax obligations and property rights. Officials consulted them when collecting arrears or adjudicating disputes. Because registers were updated periodically, every 10 to 20 years, they reflected demographic changes and land reallocation, ensuring the tax base remained current. Tax farming, iltizam, market-based collection. Rather than staffing a permanent bureaucracy, the Ottoman state outsourced tax collection through iltizam contracts. Wealthy individuals, multizim, bid at annual auctions for the right to collect specific revenues, often from urban markets, customs duties, or high-value agricultural zones. The highest bidder paid the treasury a lump sum quota, ma'al, then kept any surplus he could collect. Successful bidders had to accurately forecast revenues, accounting for price fluctuations and collection costs. If their bid was too optimistic, they faced losses. If too conservative, the state lost revenue. This system transferred measurement risk to private actors, incentivizing efficient collection while shielding the treasury from small-scale defaults. The Timar system, military fiscal integration. Under the Timar system, land revenues were allocated to cavalry officers, Saipehis, in return for military service. Each Timar grant was assessed to generate an annual income of 3,000 to 6,000 akshay, enough to equip and support a horseman. Sipais collected local dues, risem-isift, shizi, within their timar, remitting a fixed percentage to the central treasury. Revenue assessments were mathematical exercises. Censuses determined the number of shiflik units per timar, and agrarian productivity estimates, derived from tahrir data, converted those units into akshi values. Sipahis had both fiscal and military duties. Failure to provide military service or remit dues could lead to confiscation of the timar, extraordinary levies, avarus, and tekalifi urfiye. During wartime or emergencies, the state imposed avaras, extraordinary taxes, and tekalifi urfiye, customary levies, on both households and guilds. Assessments were proportionate to past obligations recorded in the defter, ensuring that communities bore a predictable share of extraordinary burdens. Officials used complex formulas to allocate these one-off dues, balancing state needs with local capacity to pay. Murtaban accounting, staircase ledgers. The Ottoman Murtaban system, a staircase method of accounting inherited from Abbasid practice, structured entries in descending order, a total at the top followed by itemized components beneath. Each entry's first word extended across the line, separating it from the next record and preventing tampering. Murtaban entries were recorded in siakat, a condensed stenographic script ideal for numeric data. Clerks, katibs, trained in palace chancelleries learned this specialized notation through master-apprentice chains. Daily audit trails, Rusname journals, tracked receipts, cash advances, and payments, providing transparent oversight. Technological aids, weights, measures, and instruments. Tax officials carried standardized weighing scales and measuring rods calibrated in regional units, oka, kyle, rutba, to ensure consistency. Iron-bound measurement rods prevented warping, while brass weights marked with imperial insignia signified authenticity. Such tools reduced disputes and anchored the tax system in objective metrics. Data flow, from village to sublime. Porta Timar holders and iltizam tax farmers submitted quarterly and annual accounts to provincial treasuries, Defterhan. Provincial defterhanas compiled these into summarized registers sent to the Sublime Porte, where central officials, scribes, and financial advisors reconciled revenues against budgets. The multi-tiered structure, with cross-checks between tahrir data, defter registers, and iltizam receipts, curtailed embezzlement. Officials who failed to reconcile accounts faced judicial review, fines, or removal. Adaptation and continuity, despite pressures from inflation, warfare, and territorial loss, core mathematical frameworks endured from the 15th to the 19th centuries. Reforms such as introducing monopoly taxes, riba, customs consolidation, muhasarat, and eventual moves toward cash salaries, layered upon the existing system rather than replacing it. Legacy and lessons for modern finance. The Ottoman tax regime demonstrates how precise measurement, systematic record-keeping, and market-based delegation can create resilient fiscal institutions. Modern states still grapple with balancing administrative costs, taxpayer compliance, and revenue stability, challenges the Ottomans met by integrating mathematical rigor with pragmatic governance. As public finance evolves, revisiting these pre-modern innovations offers valuable insights into designing tax systems that are both efficient and adaptable. And there you have it, an entire empire balanced on the tip of a reed pen, wrestling with dunhams and akshis instead of spreadsheets and pay-per-click ads. From the meticulous Tahrir teams mapping every olive grove and grain field to auctioneers hawking tax farming rights like baklava at a bazaar, and sipahis tallying their timar yields to keep those cavalry boots shined, the Ottomans proved that running a state is equal parts geometry, ledger keeping, and high-stakes bidding. Sure, today you might grumble about tabbing over 9 boxes in an online form, but at least you don't have to haggle your village's sizey in a crowded palace courtyard or fear a neighbor swooping in at auction to collect your taxes for the year. If a pre-modern empire spanning 3 continents could coordinate its budgets with counting beads and ink-stained fingers, our modern bureaucrats could probably learn a thing or two about precision and maybe inject a bit of that Ottoman flair into their next budget meeting. So, which Ottoman tax trick blew your mind? Was it the double-entry staircase method, the artful auctions of Iltizam, or the sheer ambition of mapping millions of acres by foot? Drop your thoughts below. Your comment might earn you an honorary spot in the Sublime Porte, or at least a virtual tip of the fez. If you enjoyed this dive into Imperial math magic, don't forget to like, share, and subscribe for more tales of empire, ingenuity, and a dash of spreadsheet-free wonder.